Hello and welcome back to my channel. Today I want to talk to you about exposing the company tax rate myth. And what that is, most accountants, advisors, business coaches, gurus, all of the above don't seem to explain it properly in that having a company in its most basic form will not actually save you any tax when compared with having a sole trader. Day in and day out, I'm having meetings with clients, existing and new, who are earning the 190K and think, okay, now it's time to set up a company because that's what they've heard online. And then we have to sit down and have a long chat about how that's not the only thing that you need to consider, but also how that advice is actually fundamentally wrong. This video is also purely aimed at your average small business. So not your multi-million dollar corporation, not your large high net worth individual family group that has trusts and other companies and things like that. This is just purely comparing should you have a sole trader or company if you're just looking at the tax savings or implications alone. And yes, there are other reasons to set up a company. There's many of those, and I'm going to do a whole separate video on those, but this is just tax. And the reason why I'm drumming on about this is because I did a little snippet of this on TikTok and it got a lot of angry comments. So please don't come at me. This is just going to show you the tax comparison. So let's jump right in. So firstly, I'm going to explain to you how when comparing apples with apples, it doesn't matter, once you go over that 190,000 that everyone talks about, it doesn't actually mean you're going to be saving in tax. Now, let me explain. So most accountants will say once you earn over $190,000, you're in the top marginal tax bracket, which is 47%, compared to a company, which is a flat 25%. So they talk about the difference between the 47% and the 25%, which isn't technically correct. There is a lot more to it. Now, the first thing they miss when looking at this is the fact that in Australia we pay individual tax at the marginal tax rates. Now, what this means is that it's like a sliding scale. And the way I like to explain this is to think about your money in buckets. So I'm going to put the individual tax rates up here or here, wherever I can fit them in. So we just pretend we have all of our money for the year on the table. So we take the first 18,200 and we put it into a bucket. There's no tax on that bucket. Then the second bucket, we've got 18,201 to 45,000. So in this bucket, we're going to pay 16 cents in the dollar plus 2% Medicare levy. So we're going to pay 18 cents in the dollar, 18% on this money. Then the next bucket is 45,001 to 135,000. Now in this bucket, we're going to pay 30 cents plus the 2% Medicare levy. So 32 cents in the dollar, 32% on this bucket. Then the next bucket is 135,001 to 190,000. Now in this bucket, we're going to pay 37 cents plus a 2% Medicare levy, so 39 cents, 39% on this bucket. Then we go into the last bucket. Now anything over the 190,001 is going to be in the top bucket. So that's 45 cents in the dollar plus the 2% Medicare levy, so 47 cents in the dollar, 47% of tax in this bucket. So any additional income you earn goes into the last bucket. So it's only over the $190,000 that's going to get taxed at that top rate. So this is very important to think about when we're comparing the tax rate of the company versus the sole trader. Because, for example, if you look at what the tax would be on 200,000, it would roughly be, if we average it out, 30% flat. Now, yes, that's still more than a company at 25%, but it's definitely not the 47% versus the 25% that most accountants talk about. Yeah. So it's also worth noting that a company is a separate legal entity. And what that means is, contrary to popular belief, it's not your money, it's company money. You're just an employee, a director, or a shareholder. So what that means is that in order to just pay the tax at the 25%, the money has to stay in the company and be reinvested. And you can still do this in a sole trader. The only difference would be in a sole trader, you have to reinvest it in that year, so to bring your taxable income down in that year. Whereas with a company, you pay the tax at the 25% and then you leave the money in there and you reinvest it in the next year. But if you take the money out, then you're going to pay tax in your individual name in the most basic form. Okay. And the average small business owner, in my experience, and especially with the increased cost of living, usually takes out all the excess profits for the family. Am I right? And so we're back to that individual tax rate again. which backs up my argument of not saving any tax. Now, I've prepared an example. Let's go through and let's have a look at it. Once again, we're comparing apples with apples. We're comparing a sole trader profit with a company profit, and we're comparing the tax. And we're not doing anything fancy. We're assuming that this individual, doesn't have any family to share the income with. He doesn't have family that's on lower, a lower tax rate that we can stream to via way of dividends and all that sort of stuff. So this is just basic apples with apples, okay? So we've got a sole trader here with a $200,000 profit. I've put the formula in to calculate the tax, so per the buckets like we discussed before, and that works out to be 30%, 60,138. Then we compare with a company. So company's got gross profit, same, 200K. Tax at 25% is 50. So yes, we're comparing it here. We're saving roughly 10K in tax, but it's not that simple. So then we're left with $150,000 to take out of the company. So assuming we take that out and assuming that we're not doing wages, we're just going to look at doing the dividend because dividend is the most tax effective way to do it. If you did it as wages, you'll be paying a lot more tax. So we've got a dividend of $150,000. Then what happens is the franking credit gets added on before it gets taxed. So we're back at the gross taxable income of 200, so same as the sole trader. Then we're paying the tax at the marginal rate, which is the same. Then we take off the franking credit. That's the tax that's already been paid by the company. And we're left with 10,138 personal tax, which, yes, is less. But if we're looking at overall, we're paying 10K personal tax plus the 50K company tax, which means we're paying exactly the same tax no matter which structure we're in. And it doesn't matter, you could change this to 500,000 and they're still going to be exactly the same. Now, there's a few nuances to this. So usually you wouldn't be able to pay a dividend out on the exact same amount in that year unless you've got franking credits carried forward from a prior year. And there's a lot of other weird and wonderful things to this. But once again, this is the basic form. And I think I've just debunked the myth. So I hope from watching this video, you've learned a little bit about the company tax rate versus the individual tax rate and how having a company just for tax purposes alone is probably not the right strategy. So please don't set up a company yourself without first speaking to an accounting professional to make sure that they're looking at all the different pieces of the puzzle and ensuring it is the right structure for you. But if you are going to DIY, make sure that you speak to an accountant before the end of the financial year each year, because it's really important that certain things happen in the company. So it's important if you've taken money out, it goes through as wages, through STP with super and tax, and that you register for pay-as-you-go withholding to pay the tax. Or if you're going to pay it as a dividend, you want to make sure you've got enough franking credits. You want to make sure you're declaring the dividend before 30 June. There's a number of compliance issues that have to be dealt with in a company. But the sole trader, not so much. So please don't just go setting it up and leaving it there, because you're going to be hit with lots of tax that you didn't expect because you haven't done things properly. Now, I haven't done this video to scaremonger anyone. I've just done it in an attempt to educate so that people don't just hear those accountants, advisors, business coaches, gurus telling people if your profit is over 190K just to go up and set up a company. Okay, I want you to be educated. I want you to understand. So please, please, please don't go taking anything I've said the wrong way. I just want to help you. I also don't like being the bearer of bad news when someone comes to me after setting up their own company and they're 2 years down the track and they say, Natalie, nobody told me, but they've set it up themselves. And it's really hard to try and unravel some of the things that they've done, right? So please don't be one of those people. And as you can see, there's a lot more to working out which structure is best. So when a client comes to me and we sit down and we look at which business structure is best for their business, we look at things like what sort of business are they in? Is it risky? Are they going to get sued? If it is, what's their risk appetite look like? Are they someone who likes risk or not? Do they have assets that need to be protected? Do they have a spouse who's working? Do they have a spouse who's a high income earner? Do they have other entities and investments? There's many things that we ask to make sure that you're in the right structure. So it's not just a black and white. People are always asking me, so Natalie, what's the right income level to move to a company? And there isn't really an answer on that. It just comes down to many different factors, including the income. So, I would say as a ballpark, and don't quote me on this, I would say you want a profit of at least probably 500,000 if you're just looking at that alone and you're not looking at the risk and all the other things that I, explained before. And my accounting firm, Two Sides Accounting, is now taking on new clients. We've just reopened our books after a period of having them closed because we just couldn't take on any more clients. So if you would like to have a chat about your individual situation, or if you're looking for a new accountant, the details will be below and on the channel information itself. Now, I will also do some videos after this video, because this video is already probably long enough, in regards to tax strategies. So how you can use a company or a trust or a combination of both to save tax and defer tax. So if you like this video, please give it a like, give me a comment, that helps with the reach. Make sure you subscribe, share it with a friend, share it on socials, and I will see you very, very soon.